Hello traders, James Stanley with StoneX and Forex.com. There's an old saying, bull markets don't die of old age. They die because of the Federal Reserve. Well, it's a variation of the quote, at least. And it often harkens back to the fact that in many cases, the excess, the over leverage that pushes in those massive bull market environments eventually needs to be pared back. Eventually, it shows through via inflation, and eventually that's something that has to be addressed by the Fed. Well, it was just a couple of weeks ago that the AI bubble was all the rage across financial headlines. A couple weeks later, with the S&P 500 reapproaching that prior ATH, those headlines have seemingly fallen by the wayside. For what it's worth, I do still think that there are bubble-like conditions, but like I said in the video last week, I don't think it matters from a strategy perspective because those conditions can stretch for a long time until ultimately something has to change or something has to shift, and I don't think that we're there yet. As a matter of fact, it seems like matters are aligning for perhaps the opposite scenario, where we might be in line for a melt up type of ordeal into the end of the year. I wanted to explain that in this video. I wanted to look at this from a couple of different vantage points, a couple of different perspectives, and I wanted to try to keep a balanced argument as we look at the stocks as we go into the end of what's been a massive run since the April lows. So let's start chopping this up. So first and foremost, the technical perspective on U.S. equities, at least SPX, we've had a V-shaped reversal over the past couple of weeks, but it was what happened right here that I think stands out as what remains as a pertinent driver, and that was October 29th. That was the last Fed rate decision, and keep in mind, we got a cut at that meeting. But what was more impactful was that Jerome Powell refused to commit to another December cut. He said December is not a foregone conclusion. It didn't take long for those expectations for a December cut to start paring back, but we were at a veritable coin flip a couple weeks later. And then as we dip down towards that 6,500 level, that's when we started to see legitimate fear that, hey, maybe the AI bubble has popped. Well, at this point, even with stocks, I mean, we can measure this in SPX. We are like less than 1% off of the all-time high. Even with stocks at that elevated range, at that elevated level, the Seen in Fear and Greed Index is still showing fear. And this highlights that if we do see this push back in towards neutral or greed, if we see that sentiment shift more optimistic or more positive, even if just a little bit, there could be fuel for stocks to push up to fresh ATHs and beyond. Now, when I say melt up, I'm referring to this on a shorter term basis because if we look at this longer term, it's already stretched, which, again, can be emblematic of a bubble. But what I'm looking for as far as top-end targets are concerned, it's exactly what I said in the Q4 technical forecast, which was looking for a year-end target of 69.58, confluent with a 7K psychological level. I think there could be a pause point at that 7K level if that comes into play by the end of the year. But as I said in that forecast, I also didn't want to chase it. I wanted to look for support around 6,500, and that, perhaps not coincidentally, is what buyers had defended just a couple of weeks ago. But what is it that happened in here? As that's what I think is the next major driver. This was the release of the non-farm payrolls report for the delayed report for NFP. And the data wasn't good. But it did give greater probabilities, greater expectations for an ultimate rate cut in December. A day later, Kevin Hassett is on Fox Business, the Kudlow program, and he essentially calls out Federal Reserve officials for not being dovish enough, not highlighting that December rate cut potential. And this is also when Kevin Hassett's star rises a little bit more for that next Fed chair position. A week later, and again, cover that in these videos, Kevin Hassett is listed by U.S. Treasury Secretary Scott Bessent as the frontrunner for the Fed chair position. Another jump. And then over the weekend, Trump is asked about it. He didn't directly comment, but he kind of had a smirk. He said he knows who the next Fed chair is going to be, so it sounds like the decision has already been made. And the wide expectation is that it's Kevin Hassett, the current director of the National Economic Council. Well, if we look at Kevin Hassett's history, And there's a lot of allegations of partisanship, of being loyalist to Trump, and those things might be true. But I think more than that, Kevin Hassett is an uber dove. This was from September of 1999, and given that I think we might have bubble-like conditions, I think it's worthwhile to look at that prior bubble, which has a lot of similarity to what showed in 1999 and 2000. Now, as we came into this year, I made that link in the 2025 forecast for equities. I talked about the very rational comparison between AI stocks today and .com stocks then. But in both situations, in both scenarios, knowing that it's a bubble isn't enough. Now, in this piece, Kevin Hassett essentially excoriates Alan Greenspan for the insinuation that there is a bubble. Now, this was from September of 1999, and he's talking about a speech at Jackson Hole on August 27th, in which Greenspan alludes to bubble-like conditions. And then, notice the key line down here, but the clear implication was that this market is a bubble, and you may have to raise interest rates to prick it before it gets too big. We're going to get back to that. He also goes on to reference a speech in December 1996 when Greenspan had the initial irrational exuberance quote. Again, covered that in the video a week or two ago. Now, interestingly, this is often looked at as a highlight of Greenspan's tenure when he identified a bubble in the early stages. Here's the problem with that. In December of 1996, the NASDAQ 100 was still below 1,000. It then went on to gain another 480% until ultimately topping in March of 2000. When Kevin Hassett wrote this in September of 1999, the bubble at that point was far more developed. The NASDAQ went on for another 100% before ultimately topping in March of 2000. And even when it topped in March of 2000, we didn't know that it had topped. As a matter of fact, what Hassett had alluded to here, raising interest rates to pop the bubble before it gets too big, well, perhaps not coincidentally, look what the Fed was doing in 1999 and 2000. 1999, they hiked rates 25 bips in June, August, and November. In February and March, another 25 bips at each meeting, and then 50 bips in May of 2000. Now look at where the S&P 500 was at the time. Again, 1999, the Fed is hiking rates in 25 bip clips. It was May of 2000 that the Fed had its final rate hike of 50 basis points, right in here. Now, at that point, S&P 500 goes up, attempts to retest the all-time high, fails, lower high, and then it comes unwound. Again, timing bubbles is incredibly difficult, but this is a good case, speaking back to that quote of where this bull market died from an overactive Federal Reserve. With Kevin Hassett, an uber dove, coming in atop the Fed, highly alleged, believed to be coming in atop the Fed, that is not the same concern. So, for next week, the 25 basis point rate cut, it's, I think, already well baked into the cake. The odds for that right now are at 87%. If we didn't get it, it would be a disappointment. I think these odds should probably be closer to 95 or 98%. The bigger question is next year. Now, this has been something that has been holding stocks back for most of this year. Inflation has remained high. The Fed has remained very cautious from committing to too many rate cuts, even though they've cut 50 bips already this year. But they've seemingly wanted to retain a bit of prudence, given that inflation was still at an elevated level. Now, interestingly, they didn't have that same prudence in 24, but it's another matter altogether. But right now, markets are expecting the Fed to lean heavier into cuts next year. And this has been given some run since the Kevin Hassett news. So this seems like markets are expecting Hassett to get the next job and expecting him to be able to bring some impact within the voting members of the Fed. For right now, the wide expectation is for their 50 or 75 bips in cuts next year. This is, again, just taking from markets and their expectations right now. But if we look at the summary of economic projections from the last quarterly rate decision in September, you'll notice there's divergence here. The Fed's widespread expectation is that we were going to end 2026 between 3.25% to 3.75%, with the bulk of those expectations between 3.5 and 3.75. Markets are looking for rates to finish next year down in here. So if we do get that push from the Fed in the dot plot matrix next week, lower towards what markets are looking for, I think that provides fuel on the long side of equities that could give this another boost higher. Now, we're at the stage where the trend is looking beleaguered already, but I imagine that there are a host of stop orders setting above that high from traders that are trying to take this short, or that are trying to work a bear swing, or trying to call an AI bubble. And if that is the case, and we get those stops hit, stops on short positions or buy to cover logic, that's an influx of demand. That gives another push higher. Now that 69.58 level, it was like less than 0.6% away on October 29th. That 7K level is another matter entirely. We get above 7K, it's one of those psychological levels. It becomes difficult to just run right through a price like that. Oftentimes it takes some grind because people that have held from 6,800, 4,100, 3,000, once we get above 7K, they take notice. And that's not a terrible area to start taking profits or repairing some exposure, and then look for a pullback and then try to get long again. But those major psychological levels, they often take time to break through. I mean, 6K was a pretty good example of that. It started to come to play in November of last year. And it took a while before we could ultimately leave it behind. But 7K brings a similar amount of drama. Now, for that, I think that's more of a 2026 argument. And I think that's something where we're going to need to see lower levels of inflation to substantiate the topside run through that price. But right now, from a technical basis, we have a V-shaped reversal. In equities, we have a strong rally since the Kevin Hazen news has taken over. And there's no reason for the Fed to try to talk this down from the ledge at this point. We just had a very notable pullback. There's a lot of fear still in the market. If we see that fear abate a bit, and we see some enthusiasm push into the end of the year with the possibility of a Santa rally also taking over, I think there's a lot of factors that are starting to coalesce, or that have been coalescing, for topside bullish strength in equities. I don't think we're in a place yet where the AI bubble bursting is a central theme to start looking at. I think the risk factor on that is if we do see high inflation as we come into next year, something to the point where the Fed has to address it. But I mean, even if we look back, just at recent history, this pullback in stocks was when the Fed refused to talk about rate cuts. Now, at that point, they said it was because of tariffs, but you look at the data, there was an inflation spike after they cut rates last year. Fed refused to talk about rate cuts. We got a pretty nasty pullback. When we look at the 2022 move, this is when the Fed had to hike rates because inflation was so high. And, COVID had its own set of risks, but the Fed was offsetting that with uber dovish, loose monetary policy. 2021, we had raging inflation. Fed refused to hike, and look at how stocks responded. They had one of those melt up kind of thesis. And I don't think there's a reason for the Fed to try to talk this down right now. I don't think that's what we're going to see in December at least. And that's not a problem that I think they're going to encounter until they absolutely have to. And with Kevin Hazen and Uber Dove set to take over at the Fed, there's more and more, again, things all lining up for this to produce a melt up type of backdrop in stocks as we go into next year, and maybe even through the early portion of next year. But that's what I have for today. That's what I have for this week. That's what I'm looking at for next week's FOMC rate decision. As always, thank you for your time and happy trading.